What is an investment? In this lesson, we continue describing the general framework of the course in elementary finance. In this course, we shall study investments. So, what is it? Of course, we shall study the two basic types of investments, which are buying machines or plants, and secondly, buying financial securities, that is, shares of stock of a firm, or bonds, or insurance policies, etc. We shall see all that. But it is useful to see them from a higher viewpoint. Investing is relinquishing, that is, postponing consumption that could take place today in order to produce value in the future that can be consumed or otherwise used then. Therefore, time, as we already saw, plays a fundamental role. For instance, a firm which has the following projected cash flows. Today we have nothing. In 1 year we have a cash revenue plan of R1, a cash outlay plan of S1, and therefore a net cash flow in 1 year of T1. And same for year 2, in 2 years, R2, S2, and T2. In year 3, R3, S3, and T3. It may or may not continue. And suppose this firm decides today to invest a sum, say M, in order to reduce the future cash outlays. The cash outlays that we just saw. We plan to reduce these cash costs, in other words, with an expenditure today of M, and therefore we shall increase our net cash flows. So suppose the reductions will be delta S1, delta S2, and delta S3. Then the investment can be represented this way. Today we have a cash outlay of M, and we have in the next few years cash, extra profit of delta S1, delta S2, and delta S3, and possibly more. Let's look at the same thing with numbers. Suppose we can invest today 100 million euros in order to save over the next 3 years 50 million euros the first year, 80 million euros the second year, and 40 million euros the third year, and that's it. Well, we shall study under which conditions this is a good investment and under which ones it is bad. And we shall be more sophisticated than just saying, well, after 2 years or year 2, we have already paid back the investment. Because indeed, after year 1, we have already recovered 50 million euros, and after year 2, we have recovered altogether 130 million euros. So the payback, but this is a very crude evaluation of investment, the payback is less than 2 years. But as you remember from lesson 1, we shall actually be concerned with the value today of these 50 million euros, the value today of these 80 million euros, and the value today of these 40 million euros in year 3. And what we shall be interested in truth, is comparing the values today of these 3 future cash flows with the initial expenditure. Let's look at a second example, financial in this case. You have 1,000 euros in your pocket, and a borrower offers you the following deal that will take place today. You are the investor, and the borrower will enter the following transaction. You give the borrower your 1,000 euros, which are in cash, and the borrower today gives you a promise that somehow you bought with your 1,000 euros. And this promise, which is a contract, stipulates that you will receive 50 euros per year for 6 years, and year 6 you will also get back your 1,000 euros. So for you, this investment can be pictured this way. Today, you shell out 1,000 euros, and then in 1 year you get 50 euros. In 2 years, you get also 50 euros, year 3, 50, year 4, 50, year 5, 50, and year 6, let's number them. And year 6, this is time, year 6, you get 1,050 euros. That's the deal that we are looking at. There again, we shall study under which conditions, that is, quality of the borrower, economic environment, this is an acceptable investment. The contract we just saw, let's see, that was this picture. This promise, as I said, is a contract signed by the borrower and perhaps by yourself. The contract is called a bond in this example. Bond because it ties somehow the borrower to promises. And more generally, such a promise belongs to what are called financial securities. It is a financial security. As we said, investing, generally speaking, is postponing consumption today to reap value and consume in the future. Many examples fit this definition, not only the two that I just gave. Here are some more. Studying to get a formation and a degree instead of partying is investing into one's future. Secondly, setting aside part of a harvest to plant next crop is definitely an investment. But even storing a harvest for consumption in winter, that can be viewed as an investment, although just in the winter we shall consume the harvest that we have stored aside. Buying gold to sell it later on is also an investment, and this purchasing of gold may or may not be done with a speculation in mind. You may just want to sell it back in the future, or you may count on an increase of the price of gold in the future, which is something that is going on right now in the world. Another example is rehabilitating an apartment building to rent it. All these are investments, and in this course we shall study, as we said, the two main types, which are buying machines and buying financial securities.